Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ Investors, welcome to the show. It's great to have you here. I stirred up a little bit of controversy earlier this month on Instagram through our account, Charlie Munger Quotes. I shared the following as a text post via Instagram stories. Let me read it to you. I said, one lesson that Charlie Munger's investing success illustrates is that all you need is 2 or 3 great businesses to make a fortune. Much higher probability of success than doing ARK ETFs or Robinhood day trading BS.
Hey now.
Yes, that's what I said, and I stand by it. Now, I received a number of questions, and I'll read a few of those to you, the last of which I'm going to respond to in this episode. The first message in reply that I received in our direct messages is from PsychoBoy824, who says, Franco, you're a dead man. The next comes from someone, and I'm not going to read the full name just to protect their privacy, but it's Kathy Wood, BFF. They write, and it's a little tricky because there's emojis, but it says, I'm going to gut you like a, and then it's just the fish emoji. So not sure what they mean. Maybe it's like some inside reference, but last but not least, and this is what I will respond to, comes from Bryan. Bryan says that I agree that it's best to be concentrated and knowledgeable about a few companies that are good ideas trading at good prices. But what do you think of the argument that some people make that when you're younger, you should be more enterprising with your strategy or even more speculative? It's a great question, Bryan. I appreciate you asking it, and I also appreciate you not threatening my life. And by the way, those first 2 were just to make you laugh. Those were not real responses. But Bryan's is totally real. So let's get to it. I'm excited to answer this question. I think we'll have a great episode, that comes out of this. So before we go any further, I want to make sure that I say this. My response is not intended to be investment advice. You should seek a duly licensed professional for investment advice. I am not selling any sort of investments or investment management services. If I name drop or recommend anything in my answer, it's purely from my own experience. It's not investment advice. Please do your own research. There's one thing I can encourage you to do, and I think Charlie Munger would agree, independent thinking. So let's get back to Bryan's question. Here's what I think, and I'm just going to go off the cuff. I believe when people say that, you should be more aggressive, or as Bryan said, more enterprising when you're younger, really what they mean is, or what they're referring to is having a higher percentage of equities versus when you're getting closer to retirement. And it kind of an old school formula, I don't know how old it actually is, I'm just calling it old school, is you take 100 and you subtract your age, and whatever that number is, that's the percentage that you should have in equities. The rest you can put in something like bonds, but I don't know if that's the best option in today's climate.
Dogecoin.
With that being said, I use a different filter that I think is more useful, and that's just the simple filter of opportunity cost. Charlie says it like this, and this is from 1994. Opportunity cost is a huge filter in life. If you've got 2 suitors who are really eager to have you, and one is way the hell better than the other, you do not have to spend much time with the other. And that's the way we filter stock buying opportunities.
I love it.
What I always wish I could have asked if I was there in 1994, and I was like 6 or 7 years old, but if I was there now in 1994, I'd say, what if you have hundreds of suitors? I mean, what do I do? It's a really challenging situation, and I don't have anyone else to relate to. Please help me out, Warren, Charlie, anybody. To paraphrase something Charlie said in 2007, and to be totally serious, opportunity costs are what you want to make your decisions based on. Bryan did not say he's 23, by the way, but that's 10 years younger than me, and I think of, what advice I'd give to myself 10 years ago. So the first thing is, don't do anything speculative. That's just not a good idea. The biggest advantage you have if you're in your 20s, whether you're early 20s, mid 20s, even late 20s, the biggest advantage you have is time. Don't screw it up by investing in something that could potentially be a big loss. You'll come back from it, but you'd be much better off if you're just consistently gaining on aggregate without any big losses for as long as possible. I would recommend an S&P 500 ETF, specifically Vanguard's. It's VOO is the ticker. The expense ratio is only 0.03%. You can compare that to something like one of Kathy Wood's ETFs, which is, I think, 0.75%. Makes a very big difference over a long investing lifetime. Keep in mind that since inception, which was in September of 2010, the VOO has achieved average annualized returns of 13%, and that's after taxes. So I know you might be saying, okay, 13%, that's the best I'm going to do, or that's my opportunity cost. Is there an opportunity that I think could beat that I understand? Well, I want to say one more thing. Lower your expectations about future returns.
Big money.
I love the idea that more and more people are realizing that compound interest is so powerful. And that's something I see on our Instagram feeds, and it's just the word's getting out, and that's awesome. But these assumptions about what the rate of return will be are overly optimistic. There are a lot of factors that could easily be a headwind moving forward. So one piece of advice that I know Charlie Munger has talked about is just lower your expectations. Assume, a 5% average annualized rate of return after taxes. Assume 5%, because then if you do anywhat better than that, you're going to be ecstatic. Expectation setting is just a very powerful thing. So I can't think of something better unless you know something I don't. And when I was 23, I thought I knew a whole lot, but in hindsight, I knew nothing. I also want to mention that, and Bryan, not to call you out, but this idea of beating the market by a lot, I wouldn't assume you're going to do that. Not because you're not capable of doing it, but because most active investors or fund managers fail to outperform passive indexing. So when it comes down to investing a little bit more aggressively when you're younger, the lesson is to, concentrate in equities. The biggest advantage of investing in your early 20s is the time that you have in front of you. That's the real magic that you can tap into through the power of compounding. And Warren Buffett is the best living, breathing example of this. I highly recommend you listen to episode 2 of Compound Money Quietly. It's all about compounding. It's called Compounding Your Way to Wealth. It talks all about Warren Buffett's childhood obsession with compound interest and how, his ability to grasp this concept has helped him just as much, if not more than anything, in becoming one of the wealthiest people on the planet and having maintained that position for a very, very long time period. Warren Buffett says that compound interest behaves like a snowball of sticky snow, and the trick is to have a very long hill, which means either starting very young or living to be very old. So if you're 23 and you have money to invest, you are way ahead of most everyone, and so you're in a great position. The key is to be sensible. The most sensible thing, and I believe the math would prove this, is an index. If the worst case scenario happens, you're not going to kick yourself in the head and be like, God, I was so stupid to get involved in the S&P 500 index. What was I thinking? You'll never have that reaction. You would if you put all your money in Tesla. Not saying Tesla's not going to be, whatever you hope it'll be, but that is something that you'd want to kick yourself in the head over because you're buying an overvalued stock. The biggest challenge that younger investors have is the influence of their friends. I think it's awesome that, we're more open about what we invest in, or the fact that we're investing at all, but there's just more of a social element to investing now than there was. I would recommend not following your friends. Now, if your friends are listening to this episode with you, well, you guys are going to be like a support group. Do the rational thing, because it's very easy to divert from that. So that's great. But if your friends are talking about, Dogecoin and penny stocks and certain IPOs or SPACs, if they start uncontrollably crying anytime that Elon Musk makes some sort of announcement, or if they're watching a YouTube video about Tesla and Elon Musk comes on the screen and they just start bawling their eyes out and they say, thank you, Lord, Elon. Well, don't listen to them, okay? And unless your friends are, incredible business analysts, they don't know what they're talking about. And if for some reason their investment idea works out, it was most likely luck. You're playing the long-term game. That's what we're trying to do here. Wealth is built over the long term. It's built through compounding. Another reason to consider passive indexing is because in all likelihood, you probably haven't experienced real market pain. And that happens, in a bear market. It can happen when, stocks just aren't going up all the time and you can't catch these crazy waves. It's a really interesting thing when you start to put some serious money behind one name and then one day it drops 35%. That will test your psychology. And if you don't have that down pat, you're in all likelihood going to do something that causes you to lose money. You're going to sell, you'll trigger short-term capital gains. I've been there. And actually a quote from Warren Buffett that was, I'm going to paraphrase, but dumb money ceases to become dumb when it recognizes its dumbness. Discovering that quote coincided with my epiphany that, hey, I should be indexing. So I was indexing, 80% equities, 20% bonds for quite some time, probably a couple of years. And in that time period, I was educating myself. I was putting the work in that's required to be an individual investor, an investor who is, sound in principle, sound in thinking, and has the right temperament.
Buy the dip.
One last thing, if you have any peer pressure from your friends to, be more speculative, try this. Tell them you want to have a bet. Whoever does the best over a 10-year period, you're going to do your passive indexing, they're going to do whatever they're doing. Whoever ends up with the best return in 10 years, that person wins, and they get to take the other person's entire portfolio, liquidate it, and take the money. Just see what they say. And that's what Warren Buffett did with hedge funds. Now, he didn't take the money, but he bet $500,000 that nobody would be able to outperform the S&P 500 index doing whatever they're doing because there's fees and everything else. And sure enough, he won. And 10 years is actually, even a little bit risky because it's after 15 and 20 years when the likelihood of some other strategy beating passive indexing becomes far less likely. The other advantage is that you'll have a lot more time than they do. While they're refreshing multiple monitors and reading all sorts of speculative BS during their weeks, you have time to invest in whatever you want, meaning your time and energy. And in your 20s, the best way to really, build up your base, your capital base, is to dedicate yourself to whatever your job is. Make yourself as valuable as possible. Learn as much as you can. Make connections. One of your biggest opportunities is increasing your market rate. When I was in my 20s, I worked my face off, to the point where I'd always get those friends or family members being like, why don't you take a break and all this stuff. And, I could have been a little more balanced. I could have taken a day off here and there, but I just had a drive and I went for it and I learned a ton and I made myself extremely valuable in my market. And by doing so, in part, I had, more amounts of money coming in that I was able to invest. You get the idea. I hope that helps. I hope all of you do really well. And that's certainly, we're all trying to do well, regardless of what age you are. So let me know what you think. If you've got a really great idea of what's better than the S&P 500 index over a 10-year period or more, don't hesitate to let me know. I never claim to have all the answers. I really enjoy the intellectual exercise, if you will, about thinking through the different potential options we can take as investors. Here at Compound Money Quietly, we like to base what we're saying on empirical evidence, academic studies, legendary investors, and the lessons that they teach. Check out episode 6. It's called Warren Buffett's $100 billion investing lesson. Then in episode 7, I answer the question, when should you sell the stock? I take a bunch of legendary investors and I synthesize all their answers so you get a real full perspective of what these wise investing minds would do if they were trying to determine whether or not to sell. One of those investors, Charlie Munger, always reminds us that the best thing a human being can do is help another human being know more. If you learned something from this episode, share it with a friend, help them become a little bit wiser about investing. If you're listening on Apple Podcasts, please take a few moments to leave a written review. It doesn't take very long, but it goes a very long way. And as I've said before, and I'll say again, I genuinely enjoy reading them. They're very motivational. And also, thank you to everyone who has left a review so far. It means a lot. And last but not least, we have a newsletter which you can access at cmqinvesting.substack.com. Sign up for free. You'll have access to all the newsletter updates about our specific episodes. There is a paid version, but it's not like one of these deals where we try to lure you in, and there is plenty of content for you to enjoy as a free subscriber. If you do feel like supporting CMQ Investing, then by all means, it'd be great to have you as a paid member, and there is a very unique content experience behind the paywall. With all that being said, my name is Chris Franco. This is Compound Money Quietly, the CMQ Investing Podcast. Thank you for listening. We'll talk soon.